Hey everyone, welcome to the Financial Traders Hub. In today's video, we'll look at the price action analysis across the US equities and also some other global equity markets. We'll also have a snapshot of what's happening in the oil sector. I think it's going to become quite interesting and also important for us to be on top of the oil sector in 2025. And I'll leave you with some thoughts in terms of themes to be researching for trading 2025 like a pro. Before we start off, as usual, this is not financial advice. Everything discussed is purely for educational basis. Do read the disclaimer. So, the S&P is at all-time highs. We've had an amazing bull market this year, and so is the NASDAQ. It's slightly short of all-time high. It's looking like we're going to close the year at a relatively high performance for both indices. And as we've seen throughout the year, the US has been a standout outperformer when it comes to corporate earnings compared to the rest of the world. And it's not a surprise that the equity performances have also followed suit. For a number of months now, we've been looking at the IWM as a proxy for the small cap space. And we've been having this theme that there is a very high potential for small cap equities to break out here. So what we've seen post the Trump election is large inflows in small cap ETFs. So a lot of that money has driven a lot of these small cap companies' share prices quite high. I mean, think about it. At the end of the day, the ETF money is indiscriminately buying every single small cap company within these ETFs. It's not based on fundamentals. It's just a large inflow of money that's going in and then causing a lot of these share prices to go up very rapidly. We've seen a significant move up after the election results, and whether the rest of December will continue at the same pace or whether we'll have a little bit of a correction from here. In terms of the USD, the DXY, we've had a bit of a reversal. So it's yet to be confirmed whether we're going to see a bit of USD weakness here or whether this will quickly reverse and the bull market or the rally in the USD will keep on going. So as you see in the chart, it's been trading within a tight range between 100 and 108 roughly. So it's not a surprise that the 108 level or 107 in this case has been acting as a resistance level, and the price has kind of bounced and then sold off a little bit against that level. So it remains to be seen whether the DXY can conclusively break out of the 107 range. And in this case, we need to be paying very close attention if that happens, because as we've discussed in the last presentation, there are major implications for both significant USD appreciation from here or significant USD weaknesses from here. We've been quite focused on the US 10-year as a proxy for long-term rates in the US. Rates have pulled back a bit to 4.26%, but keep in mind that in the last few weeks, trading volumes have been relatively low. So I would not be surprised to see the rates staying elevated for much longer. I think the market, especially the bond market, is quite concerned about the inflationary impacts of all the Trump policies. We've been discussing this actually from mid-September after the first Fed cut. The bond market have actually been going the opposite way, especially on the long-term rates. And this is something that's been of primary interest to us because we know that this has a large impact on the asset valuations, particularly for stocks like tech, high PE stocks. So we'll keep looking at this very closely even in 2025, because this is going to give us a lot of clues in terms of what we should be trading long and short. One thing that it's getting a lot of attention, at least from my end, it's the crude oil. with Trump coming in, there's a lot of talk that he's going to open the taps and that he's going to flood the US with a lot of crude oil. One has to wonder what the Trump policy would be and whether the US oil industry will actually implement measures according to what Trump is planning. So as an example, if Trump starts to incentivize oil, especially shale oil producers, to start working on the federal lands, will they actually implement these actions? Because that requires a lot of capex investment, and as everyone knows, for any investment one needs to see the business plan, and a large part of the business plan for crude oil or any commodity for that matter will be centered around the future expectations of the commodity price, which in this case is crude oil. So if the market is not confident that we're going to see much higher oil prices from here, let alone that, if the market is worried that maybe crude oil is going to $50, $40 next, then it's going to be very difficult to justify significant investments in the shale oil plays. So this is a very interesting junction for us, and understanding this will give us a head start when it comes to deploying capital, finding the right trades, and also protecting our portfolios by not being on the wrong side of the market. I wanted to also take a look at the yearly performances of global equity markets. So as we know, the US has been a standout outperformer, and then Europe has struggled by and large. It's still up on the year, but it's not been an easier for countries like Germany, UK, France especially, and then I think one situation that has been capturing a lot of attention is China. So we've seen that the Chinese government has announced significant stimulus measures. It hasn't necessarily impacted the market in the way everyone was expecting. It's driven a lot of speculative trading action. So a large part of the retail crowd in China have lost a lot of money because they were expecting that the moment the government starts stimulating, that the stock market will also rise in lockstep, and that just didn't happen. So a lot of people have bought at the high and been selling as the market comes down, or been forced to sell due to margin calls. So this is an area that is of great focus for us, because I think it's very difficult to have a thriving global economy without the recovery of the Chinese economy. And as we know, the Chinese economy has been undergoing significant changes structurally. Also, with the US not necessarily being pro-trading with China, that puts China in a very difficult place, because the US is its biggest trading partner. And as we've seen, the likes of Germany and the rest of Europe are not necessarily doing very well. So demand from these places would not necessarily be going in the right direction, or would not be able to plug the gap that the US might leave. So these are very, very important topics to be on top of, because capital is going to move in a significant manner when it comes to these what I call tectonic shifts in trade policies, tectonic shifts in geopolitics, and these are situations that we probably haven't seen in the past, with no precedent. And we don't know how the whole global economy will adapt to all these significant changes. We also take a look at countries in the Latin American space, like Brazil and Mexico. Mexico, for instance, is also being targeted by Trump in his import tariff policies. So we need to take a little bit of a closer look at Mexico, because whether we like it or not, they're going to be significantly impacted by what Trump decides to implement. Brazil, on the other hand, is another significant buyer of fertilizers and a few other commodities, because it's also a growing emerging economy. So we need to be on top of what's happening there, and whether we're finally seeing the light at the end of the tunnel with a recovery for Latin America. A lot of these countries in Latin America have been beaten down, whether it's from a market or equity market perspective or from a currency perspective. So whether we're going to finally see a cyclical inflection or a meaningful recovery in many of these Latin American countries. At the same time, we're having significant changes in political parties that are coming into power or about to come into power in the next elections. So very interesting situations playing out, whereby Latin America, which has by and large been socialist parties, and that hasn't really worked that well in terms of economics or in terms of meeting the needs of the economy and the people. So the population might be poised to look for political change. So we need to understand what the implications of these might be, and particularly places like Mexico. They've got significant copper mines, and we need to have a close look at this, because changes in these jurisdictions might cause significant shifts when it comes to price of commodities like copper and so on. So a quick debrief on the global state of affairs. As we know, China has been going through a lot of trouble. So they are having a big balance sheet deleveraging event. And as everyone knows, this is highly deflationary in nature. So such balance sheet deleveraging events normally take multiple years, and they tend to be highly deflationary for the economy. The Chinese government has been stimulating, trying to counter the deflationary impact of whatever's happening in China. But I think it's going to be very difficult to get back to track and to start growing and start getting inflation in the economy. I think it's still going to be a very difficult situation for the Chinese economy. In the next slide, we'll discuss this a bit more in detail. The structure of the economy in China is also changing, as the US is moving away as a trading partner and becoming a lot more hostile in terms of implementing import tariffs, and also being very public about not liking what China has been doing in the past and how they haven't necessarily played a fair game. I'm not going to dig too much into these very political topics, but there's a lot written about it. If that's of interest, please go Google, read about it. I think there's more room for the Chinese yuan to depreciate from here. So as we know, China has a lot of USD denominated debt, and the whole deleveraging event will likely put it in a position where the Chinese yuan will have to depreciate significantly more against the USD. So in such events, what's basically happening is people are pulling out their capital from China and then repatriating it in dollars back to the United States. So the foreign reserves of China, which would be in USD, are likely to get exhausted as the capital is moving away from China to the rest of the world. And all these stimulus that the Chinese government is doing comes at a significant cost. In the EU, we're seeing big challenges ahead. So in terms of security or national security, it's becoming more of a concern than ever, with Russia now launching intercontinental ballistic missiles to Ukraine. And that is a very strong message to NATO and all these European countries, because everyone knows that these missiles can hit anywhere in Europe within minutes. And it's also able to carry a nuclear warhead. So I really hope things won't get that bad. But what is quite apparent is that the EU has a lot of challenges, not just economically, but also in terms of its own national security. We keep seeing rate cuts in Europe to stimulate the economies. So I think this is going to continue. It's going to probably move in lockstep with the US just to make sure that the EU is well coordinated with whatever is happening in terms of US monetary policy. For emerging markets, what we are seeing is that the USD strength will prove to be a big headwind. So again, we don't know where the USD is going to go next. So if it's going to strengthen more, I think emerging markets will find themselves in a very difficult place. And I'm pretty sure we'll have a few crises in Asia, in Africa, lots of other places where there's a high reliance on USD debt or just USD flowing through the economy. So coming back to China, we've been talking about the stimulus done by the government. So what does it mean to us? I was looking at this steel industry PMI from China, and it's finally crossed the 50 mark, which is basically indicating that it's finally in expansionary mode. So that in itself doesn't mean that China is going to recover very quickly or it's on the mend already. But there are some factors that we can keep looking out for, which is basically how much crude oil they're importing on a monthly basis, whether that's increasing or not. We've seen a dip in the crude oil imports by China in 2024, and that's in line with the whole economy being slower than in 2023. We can also track the iron ore imports and other industrial metals like copper, aluminum, and so on. These would give us a very good idea of whether China is finally restarting its economic engine, more specifically when it comes to the industrial space. We've also seen a bit of a recovery in retail sales, which indicate that local consumption is now increasing. So if people recall, a lot of Chinese people have lost a significant portion of their wealth in the property market with banks going bust, and basically the Chinese economy itself misfiring for so long. It's quite positive to see that retail sales are finally recovering. We need to keep watching this. We need to keep monitoring just to make sure that this is a trend that is going to be lasting for a bit longer than just one good month. And again, why do we care about China? Well, as I've said, I don't think we can have a recovering global economy without China itself recovering. China is a significant part of the global economy. And when you've got such a big economy that's not performing well, then that spells trouble for the remainder of the world. And also remember, China is a big exporter to the rest of the world, and also a big importer of commodities from places like Australia, Latin America, Africa. So if the economy in China is not growing, we're not going to see increasing trade flows to many of these countries. So in terms of US equities at a sector level, what has the market been doing? So the S&P was up 1.41% on the week, and it's been a very strong week in equity markets with most of the sectors except communications, technology, and energy underperforming on the week. We've seen a resurgence in the real estate sector, It's been a few months of real estate selling off, and probably a few people not being confident that rates are going to drop fast enough for the real estate sector to kick back in. We've also had very strong performance in the financial sector, more particularly across the regional bank segment. So that's in line with the election of Trump, because with Trump, what that means is there's going to be less red tape. It's going to incentivize more businesses to be formed or to keep expanding. And of course, financials are going to be big beneficiaries of that, incentivize more business activity. Also, in terms of financials, if we look at the short-term rates and the long-term rates, there is a significant margin, which we call the net interest margin, which is basically what banks earn by borrowing money from depositors and then lending it to people who want to buy houses, businesses, and so on and so forth. So with the way rates have been moving, the net interest margin is still very healthy, and in some cases even growing. So that's a big tailwind for the financial sector. We've seen tech underperforming. I think the US 10-year rally is still acting as an overhang. If you think about it, tech stocks are considered to be long duration assets, and when long-term rates are rising, it's always going to put pressure on the tech stocks. We've seen that consumer discretionary has been a big outperformer for a number of weeks, and this has continued this week as well. When we look at the materials sector, it's been a significant underperformer for weeks, but it seems that now it's picking back up. So this is one sector to keep an eye on, because it's kind of neither here nor there. So number of weeks of underperforming, and then it has one good week. And that also happens to be in a week where the market is rallying quite significantly. So we need to understand whether materials on its own as a sector is outperforming, or whether it's just drifted upwards with the rest of the market. So keep an eye on this for the next few weeks, because that's going to give us a lot of cues in terms of how capital is moving in between all these different sectors. Industrials have also had a solid rally, so that's something that's quite positive. And I think it ties in with the whole manufacturing reshoring theme that's going to get much stronger now under Trump. We've also seen healthcare stocks recover on the back of the sell-off that happened right after the elections. So there's a lot of uncertainty, a lot of speculation even in terms of how policies could change radically within the healthcare space, whether it's amongst biotech, whether it's amongst healthcare centers, or whether it's going to be around the insurance plans and so on. So all these uncertainties do not do a lot of good for the stocks within these sectors. And it's quite interesting to see that healthcare is finally recovering after significant sell-offs in the last few weeks. So let's look at what different industries have been doing. The clean energy segment has been a strong outperformer and has kind of recovered after the Trump elections. As we know, Trump is not a big proponent of this whole green, clean energy agenda. And of course, when he got elected, as a knee-jerk reaction, it made sense that the clean energy segment could be a big candidate for selling off. Home builders have been doing relatively well this week. I think during the last part of the week, we've seen the US 10-year falling slightly. So I think that's kind of given home builders a bit of an impetus. And also, I think there is a little bit of anticipation that the Fed will cut one more time before the end of 2024. And that's going to be very good for the whole housing sector. When it comes to software and internet stocks, we've seen that their outperformance could have eventually now come to an end. Once again, the elevated level of the US 10-year yields, I think that's becoming a big headwind. And also, keep in mind that we've got companies within this segment where the results have not been spectacular. So these are companies that would typically be trading at high PEs, and any misses in not just results in terms of revenue and EPS, but any misses in terms of maybe management not coming out with a super bullish guidance will cause a significant sell-off in the stocks. So keep an eye on this, because following the elections, there has been a little bit of an indiscriminate buying from all these flows coming from ETFs. And I think in the next few weeks, we might get a little bit more of a rationalization in terms of capital now moving away from a lot of these companies that have kind of maybe benefited from these rallies without necessarily having the fundamentals improving and backing share prices where they're currently at. I think we also could be on the verge of seeing agriculture staging a covert recovery. So keep an eye on this as we go into December, because the planting season or the crop application season is gonna start very soon, and I think with that there's going to be a lot of focus on what farmers are doing with fertilizers, farming equipment, and that's going to give us a very good indication of what's going to happen within the agriculture space. If you're focusing on stock within this segment, it would be wise to also keep an eye on what's happening to agricultural commodities like soybean, corn, cotton, wheat, and a few others, because farmers are likely to invest when these commodity prices are rising, or if they're expected to be higher, because that's going to give them a significantly better yield on their investments. It's quite interesting to see that semiconductors have been the worst performer. So there's a lot of questions here. Is it just a profit-taking move that's happening within the week? Is this indicative of growth concerns ahead for the economy, not just in the US, but also in the global economy? So if you want to understand this a little bit more, I think you should start looking at the South Korean equity indices and kind of develop your own view on the sector and what's happening at a global level. Also keep in mind that with the prevalence of AI and all this buzz around it, this sector has been doing extremely well, and it's been getting a lot of orders of companies like Nvidia and a few others. They've been profiting quite significantly, and it's possible that the growth concerns put an end to the significant outperformance that the sector has seen. I'm not saying that the likes of Nvidia are going to sell off by 50% or whatever. What I'm saying is that they might not be the next outperformers in 2025. Moving on, when we look at the oil services and oil exploration and production sector, both of them have been underperforming, but that's coming on the back of strong rallies in the past few weeks. So these are also sectors of importance. We need to be on top of these sectors, because as the oil price moves one way or the other, we're going to see significant moves within the equities of companies in these segments. Now let's look in terms of where capital has been moving. So we've been saying this for a number of months now. The small cap and mid cap space is still outperforming strongly. So capital is definitely rotating from large cap to small and mid cap space, to small and mid cap companies. Basically what's happening is that the large cap space has a lot of coverage, and capital has been doing the rounds within the large cap space. So there's not many opportunities for alpha generation, and fund managers, investors, and even retail traders are looking at the smaller segments within the mid-cap and small-cap space to try to generate a little bit more alpha. And this whole space will keep garnering a lot more attention, especially as interest rates come down. And that's going to be a big tailwind for a lot of these companies. So as we know, in the past, the long-term rates have been a headwind for small-cap and mid-cap companies. So we haven't yet seen the full extent of where these two spaces could go. But as rates come down, and especially if they come down much faster than anticipated, I have a feeling that we'll see a lot of strong rallies within the mid-cap and small-cap space. So keep an eye on this. As you're generating ideas, it might be good to look within these spaces because that's where capital is moving. So what we've also seen is that the growth segment has started outperforming value this week. Of course, we're looking at this on a week-to-week basis, so it might not have a lot of significance. In my view, I think both the value and the growth segment have a lot of room to run within the small and mid-cap space. So when it comes to trade idea generation, don't just look within a small segment, as in don't say things like, I'm only going to look at mid-cap value because that's where capital is going next. No, you don't have to put these types of constraints on yourself. Look at companies within the mid-cap space, and if the fundamentals are improving, chances are these types of companies would definitely be re-rating upwards, and that would show up in terms of the share price going up. So we've alluded to this earlier. With Trump coming in, it's almost like consensus that he's going to come in and incentivize the shale oil companies to drill and produce a lot more crude oil. He's been very vocal about him wanting the US to maintain its #1 position when it comes to production of crude oil. And one of the main ways to keep crude oil production rising is by investing a lot more in shale oil. So if we look at what's happened in 2024, the US has actually been producing record levels of crude oil already. So the black line that you're seeing on the graph here, you would see that it's much higher than any other time in the US history. So this is kind of the backdrop, right? And think about it, if Trump comes in and one way or the other, he's getting the crude oil production of the US to rise even higher. The only question left here is, do we have the kind of demand to be able to absorb all that excess oil? If not, what's going to happen to the crude oil price? But before we jump the gun, we also have to pause and think a little bit about whether the corporate sector will even be putting capex to play despite whatever Trump might be doing. We know that the oil sector has been held down by the Biden administration in terms of policies that are not friendly, in terms of the Biden administration vilifying a lot of these oil companies quite publicly, actually. And of course, that creates a lot of uncertainty for long-term investors when it comes to sanctioning capex to be able to find new wells and go explore, find new reserves and develop them and start producing oil. So that's done a lot of damage in terms of investor confidence within the space. But nonetheless, right, the US has been producing record levels of oil in 2024. So keep that in mind whenever you're reading any news headlines, because capital is not going to move just because of a headline. Capital will move when actual things are happening on the ground and it's creating a fundamental strength or weakness for a particular company, industry, or sector. So I'm going to be doing a deep dive in the oil sector across all the different parts of the sector, whether it's upstream, midstream, and downstream, because I have a feeling that this sector will present a lot of trading opportunities for us, both for longs and short. So as traders, we need to be on top of the fundamentals. We need to understand what's going on in the industry. And we also need to be able to foresee what's going to happen next. Just to put things in perspective, in 2024, as of Q3 2024, these numbers are from OPEC. So this is basically the total world demand versus the total world supply. So that's including OPEC production, including non-OPEC production. And as at Q3 2024, we were kind of at a deficit of 2.5 million barrels per day. So if you look historically, this kind of deficit hasn't necessarily been there. So in 2022, we had a bit of a surplus even. And in 2021, we had a deficit of minus 1.6 million barrels per day. So that in itself is not necessarily indicative of whether we are in a situation of an oversupply of oil or not. But there's going to be a lot more factors that will determine where the oil price goes. Essentially, it will be a supply-demand equation, but to solve that supply and demand equation, it's a lot more complex than just looking at these overall numbers and saying we've got a deficit or a surplus. So we have to understand what is the excess supply capacity across the globe. So as an example, let's take a scenario where China is able to recover more quickly than anticipated. Of course, its demand for crude oil is going to rise much faster than predicted. So does the world have excess supply capacity to be able to produce enough oil to meet China's demand or even India's demand? We could also have demand from the US increasing a lot quicker than expected. In short, what I'm trying to say is if the oil demand at a global level increases faster than expected, do we have excess supply across the world to be able to cater for that? And solving that will actually give you an idea of whether the oil price could go up or down. Of course, we have geopolitical tensions that are also impacting the oil price in the short term. But at the end of the day, it's a supply and demand story. So we'll discuss this a lot more in details in the future videos. We'll dissect all these numbers and try to understand where extra production could come in. Because also one has to realize that oil is an extractive industry. So the more you extract, the more you're depleting your reserves. So if you're not investing in finding new reserves and creating the right infrastructure to be able to tap into these reserves to bring about oil production, then it's just not gonna work. So one has to realize how the oil industry works. It's not just a question of throwing dollars at the problem. It takes time once you've decided to deploy capex. It takes time to find new reserves. It takes time to build the wells. It takes time to find new reserves. It takes time to build the wells, and it takes time to be able to get to production. So in between that, the oil price will already move if there's an undersupply or an oversupply. Basically what we need to be on top of, because if we're going to play this sector quite significantly in 2025, we need to definitely be on top of these numbers. And finally, some themes for you to research in 2025. I think we have a chance of seeing a bit of a resurgence in capex across the US. So you would recall in a lot of these ISM reports, What we've been reading is that capex has stalled in the last few months running to the elections, and that's basically due to uncertainty around the Fed, uncertainty around who's going to be the next president. So now that we've got the result and we know by and large what Trump's policies would be, has he given enough confidence to people to start deploying capex and to start planning out for the future? That remains to be seen. Trump is also making his policies known, and we know that he's highly pro-US. At the same time, we've got the Fed, who's likely to cut rates in 2024, maybe once, and more in 2025. So does this provide the right type of environment to kickstart the capex cycle? I would tend to think yes, but that's something that remains to be confirmed. So if the capex cycle is reinstated, what are the implications? I think we could see much higher commodity prices. We could see a lot of activity within the commercial construction sector, the logistics sector, and also we could see a lot of strengthening within the job market. So with all of that said, we also have to keep an eye on how inflation is going to be impacted by this resurgence in the capex cycle. We'll come to that a bit later. In terms of the next theme, it's around AI software. So we've seen a lot of activity from AI at the hardware level with GPUs, NVIDIA, and a few other companies, components that allow for rapid transmission of data, storage of data. So all of these have been hardware play by and large. I think the next wave will be unleashed at the software level, and that will take the form of productivity gains, which would lead to higher margins. I think a lot of companies will also use AI and its capabilities to improve their product offering. This would allow them to differentiate themselves from the rest of the industry, creating better prospects for revenue growth and also for higher margins. We also have companies that have a lot of customer data. As an example, transactional data that maybe a fintech company is able to gather by virtue of it allowing people to do business with it. So how can these companies leverage on AI to be able to monetize this data? It might not be a direct form of monetization of the data, but it could come in the form of a better product that offers personalization, customization, and meets the need of customers a lot better. It might also come in the form of the company understanding customer needs a lot better and designing products where customers would be willing to pay much higher. So another theme that I think would be quite major in 2025 is a potential for inflation to come back. Is a reacceleration of inflation likely? I would say yes, very much so. I think the bond market at the long end is telling us to be very careful here. Not just because the Fed is probably too dovish according to the bond market, and also in combination with the fiscal policies that Trump is likely to bring about. I think the bond market is getting very nervous when it comes to the prospect of long-term inflation. If you think about it, Trump has won both the House and the Senate. And whenever that's happened in the past with US presidents, it's always led to the US deficit increasing. In terms of how can we play this theme, I think the way we need to probably look at it is we don't just want a trade to play inflation. We want to have a few of our long trade ideas, which are companies that are doing relatively well, where they have pricing power. And in the case of an inflation comeback or reacceleration of inflation, these long ideas would probably do even better. So they are by themselves very good long ideas, and they would get even better if you have an acceleration in inflation. So we've seen this play out at the end of COVID, right? When there was a significant acceleration of inflation. a lot of companies with pricing power were big beneficiaries of inflation. And in terms of shorts, I think one way to play this would be to just short long duration assets like tech or high PEs. But be very careful here. Don't just short any tech company or any high PE company. Do the work and figure out if the fundamentals within these companies are weakening. Because if you have a combination of both the macro and the micro happening in a particular trade, what I'm trying to say is at the macro level, you have an inflation comeback, and at the micro level, you have fundamentals that are weakening further. So the combination of these two could drive stock prices to go down quite significantly. And if you're positioned for this, that's going to make you a lot of money. I think this is something we've discussed quite a bit, the catch-up of mid-cap and small-cap companies. I'm not going to dig too much into that. What I'm going to say here is that there's a lot of room for both the value and the growth segment to be generating alpha. So if you're looking for long trade ideas, definitely look within these segments. A lot of companies within will definitely be moving a lot more in the future. So another topic that's been of great interest, import tariffs. Generally, what import tariffs do is that it would weaken the currencies of the exporting countries that are concerned, like China, Mexico, Canada, probably even a few others that we haven't got in the list here. So these countries have significant risk of currency devaluations against the US dollar. How do we play this? We could express this as a short at an ETF level or even at a single stock level. So make sure you do your work here, because currency devaluation doesn't necessarily mean that at a single stock or even at an index level that the equity price will go down. In fact, it would typically go up. But if you find the right type of companies, especially cyclical companies that are highly exposed to trade with the US, that these ones might tend to be good picks in terms of shorts. Also, if we end up with more USD strength in 2025, look for shorts in places like Asia or countries with high USD denominated debt. A high USD will put a lot of pressure on these countries. We've seen this happen many times in history. So you can go study the Asian crisis, the Mexican pesos crisis, the Turkish lira crisis. So many examples to look from. Trump has also come out and said he's going to impose tariffs on Canada, which could be a bit of a problem here, because 40% of the US crude oil imports come from Canada, and the Canadian oil, and basically the crude oil imports from Canada would go to refineries that are set up to process that type of oil. These refineries would normally be in places like the Midwest, which is landlocked, where it's very difficult to ship crude oil from other parts of the US. So you can imagine it's going to be very difficult for them to replace the Canadian oil and replace that with another type of crude oil from any other part of the US. So chances are, if he puts import tariffs and he does not exclude Canadian oil as part of this whole policy, that these refineries will have a very difficult moment, because overnight the input cost of the refineries would go much higher, and that would mean that they will have a much lower margin. And it's also likely that with the new economics, they will just not be able to function. That remains to be seen. Not probably something that you would play outright at this point in time. It's something to just keep your eye on. And also, as we discuss the oil sector in more details in the next few videos, I think this will give you a very good understanding of where to find good longs and good short ideas with all of this backdrop. It's important to know what happens within the industry before you're able to understand what one policy or one event could do to a particular type of company. I think with import tariffs, we should also see a lot of opportunities within the US, and that could mainly come from local producers. I think local producers could get a boost. We've got a number of local producers of steel, aluminum, other metals in the US. So start doing your research. Maybe you find very good long ideas within these spaces. I think China has always been a bit of a problem in these industrial metals, because they would normally tend to put a lot of pressure on the prices of these metals, because they would be able to export a lot of the excess capacity that they've got locally to the US and EU, thereby driving the prices of steel and aluminum. So with China having its own issues, and also the US probably going to be a lot harsher on Chinese trade, I think this is going to give a good boost to local producers. So a lot of these companies would be able to maybe command higher margins. And definitely these are companies to watch out for, because the share prices could rise quite significantly from here. This could be quite a good trade, especially if we get a little bit of a cyclical recovery within, let's say, the automotive space, and demand for steel or other metals start rising, because maybe, you know, the whole reshoring of manufacturing within the US creates a lot more demand for industrial metals and so on. So just keep an eye on all these happenings, because it's not necessary that you'll have a confluence of all of these things happening at the same time. But generally, what could happen is one or two things could be happening at the same time, which give a big impetus to local producers. I think what the import tariffs also mean is higher prices for consumers. So a lot of companies have already announced that they're going to pass on any extra cost directly to the consumers. That to me sounds inflationary, not to say highly inflationary. So something to keep thinking about, because at the moment the consensus is that inflation has come down. But if in 2025 we see a resurgence in inflation, that's going to be totally against consensus, and that's probably going to cause a lot of volatility in markets. So we've spoken about the USD strength. How could we actually play that in our portfolios? What we could do is to start looking for US-based companies that have a high revenue exposure to areas like the EU and Asia. So if you maybe use a rule of thumb, if there's more than 40% of revenue coming from the EU and Asia combined, and then start looking at these companies a bit more in detail to see whether they could be good shorts. These might be fertile areas to start looking at. When it comes to longs, again, related to this whole import tariff theme, I think we could be looking at companies that are exposed in the manufacturing reshoring theme. We've mentioned commercial construction before. There's also robotics, industrial automation systems. These have been quite in demand because they allow the US industrial space to kind of leapfrog to the latest technology when it comes to industrial manufacturing, in order for them to capture as much efficiency gains as possible. I think the logistics sector could also be a big beneficiary. So for instance, I think we probably will need more warehousing, or warehouses would be able to charge higher prices. Also, with a lot more goods produced locally, there's going to be more transportation needed along with storage. And that in itself will create a lot more opportunities within these sub-segments. Lastly, we've got the infrastructure projects that have been ongoing. So I don't expect Trump to slow down on this. If anything, I think he would want to make this a pillar of his strategy. He's been very vocal right from his first term that the US infrastructure is old and that other countries in the world have much better infrastructure than the US. So I expect him to spur a lot of investment in infrastructure that takes the form of roads, bridges, electrical grid. What we need to do is to start looking for companies that are exposed to these themes. These would take the form of consultancies, engineering firms, maybe cement providers, steel providers, and a lot more. I mean, these are big value chains, and if you do your research, you'd be able to find a lot of long ideas here. So that brings me to the end of my presentation. Please share your thoughts in the comment section down. I'd really love to hear how you find the presentation. And if you're not subscribed to the channel, you know what to do. Click the subscribe button and stay tuned for more such videos. It's going to be a fantastic year in 2025, so keep close, keep following, keep learning, and keep trading very successfully.